Missiles don't just destroy cities, they move markets. An explosion in the desert can send oil prices surging in Tokyo. A speech in Washington can make a currency tremble in Tehran. A military maneuver near Israel can quietly raise shipping costs across South Asia. This is not just war, it is finance by other means. The Middle East is not only a battlefield, it is a financial chessboard where the real pieces are oil, sanctions, currency, and debt. Nearly one-fifth of the world's oil passes through the narrow Strait of Hormuz. Think of the global economy as a giant engine. Oil is the fuel, and Hormuz is the fuel line. When tension tightens around that corridor, inflation doesn't remain regional. It spreads globally through transportation costs, manufacturing, food prices, and household budgets. Oil is priced in US dollars, reinforcing the dollar's dominance in global trade and financial reserves. That gives Washington extraordinary leverage. Access to dollar-based systems determines participation in international finance. Sanctions can freeze reserves, isolate banks, and restrict trade flows, turning payment infrastructure into a strategic weapon. For countries under pressure, export revenues fall, currencies weaken, and inflation accelerates. What appears diplomatic on the surface can function like economic siege warfare beneath it. Meanwhile, deterrence creates another layer of fragility. When military signals are interpreted as strength, markets calm, but miscalculation can trigger volatility in seconds. Insurance premiums jump, tankers reroute, capital flows into safe assets, and emerging markets feel sudden outflows. In today's interconnected system, perception alone can move billions before a single shot is fired. The real danger emerges during escalation. Imagine a disruption in the Strait of Hormuz that significantly slows oil shipments. Even a temporary interruption could send crude prices sharply higher, forcing central banks into a dilemma: cut rates to protect growth or keep them high to fight inflation. Governments might expand defense spending, widening fiscal deficits. Countries with heavy external debt could face currency depreciation and capital flight. What begins as a regional confrontation could evolve into a global economic shock. The uncomfortable truth is that modern conflict operates on two levels at once: the visible battlefield of missiles and alliances, and the invisible battlefield of interest rates, trade routes, and currency dominance. The real question is not who fires first, it is who controls leverage. Because in this silent financial war, the next move may come not from a missile launch, but from a central bank, an oil terminal, or a sanctions announcement.